Welcome to The Explainer. Today, we're completely skipping the fluff and getting right down to business. Because we're going to connect some hidden dots between a kinetic war in the Middle East and your personal investment portfolio. You know, the global supply chain, military realities, and financial markets, they're tied together in ways you almost never hear about in mainstream headlines. So, to kick things off, I want you to think about a seriously bizarre question. What does a Tomahawk missile actually have to do with your investment portfolio? Now, I know it sounds like a trick question or maybe a huge leap in logic, but the answer to this is going to instantly bridge the gap between military action and global finance. Okay, 500. According to market analysts tracking defense manufacturing, an estimated 500 ounces of silver are packed right into the advanced electronics of a single Tomahawk cruise missile. That means every single time one of these is launched, that precious metal is quite literally vaporized. It's wild to think about, right? It shows us exactly how modern warfare directly and permanently removes critical wealth and resources from the global supply.
All right, let's dive into this. Section 1. The military battlefield. Kinetic realities on the ground. To really grasp the massive economic shockwaves radiating out right now, we have to look at the grim reality on the ground. Based on our source material, since the initial strikes, 18 U.S. service members have tragically lost their lives amid sustained kinetic U.S. strikes back and forth inside Iran. But what's highly alarming from a global perspective is Iran's asymmetric response. Specifically, they're targeting dual-use critical infrastructure. For instance, they've set their sights on Kuwait's desalination plants. If those freshwater facilities get knocked offline, we're talking about an unfathomable humanitarian crisis in highly populated desert-based cities like Dubai and Kuwait City. This really highlights the clashing objectives at play here. On one side, the U.S. military is totally focused on keeping global waterways, like the Strait of Hormuz, open to pre-war traffic levels. They also want to halt nuclear enrichment, keeping a really close eye on heavily fortified, hard rock subterranean sites like Pickaxe Mountain, where enrichment could easily cross that 90% weapons-grade threshold. On the flip side, in stark contrast, Iran's strategy leans entirely on regional disruption. They're threatening to block Gulf oil flow completely, and as we just mentioned, target that critical regional infrastructure.
So, that brings us to Section 2, the hidden supply shocks, choke points, and unexpected byproducts.
Whenever we talk about choke points like the Strait of Hormuz, we usually just talk about oil. And yeah, for sure, blockades cause crude price spikes and deplete strategic reserves. We know that. But the impact is actually way more diverse. Think about trapped shipments of fertilizer. That squeezes agricultural margins in places like the American Midwest, directly threatening farmers' livelihoods. And then, there's what might be the most surprising casualty of a blockade: helium, which, believe it or not, would literally halt global semiconductor production.
Wait, helium? Really? Yes, this is the totally unexpected casualty of war. Our sources highlight that this isn't just the gas you use to fill up party balloons, it is an absolutely critical, irreplaceable technological component.
Here's how this unexpected supply chain actually functions. First, Qatar extracts liquefied natural gas, and helium is captured as a highly valuable byproduct. That makes Qatar a massive global supplier. Now that helium must be shipped out through the Strait of Hormuz to arrive at major fabrication plants or fabs in Taiwan. Over there, it's absolutely essential for manufacturing the semiconductors that power artificial intelligence. So a blocked strait in the Middle East, that directly and immediately threatens the global AI and microchip race.
Let's move on and see how this all builds. Section 3. Silver and the War Machine. Depleting the defense industrial base.
Pivoting from helium back to weaponry, we hit a genuinely staggering number: $37.5 billion. That's the estimated cost of this conflict so far. And guys, it's rising fast. The U.S. Congress recently moved on an additional $95 billion package. The primary goal of that money? Replenishing heavily depleted stockpiles of advanced weaponry, like Patriot and Tomahawk missiles, which have just been burning through the defense industrial base.
In fact, military intelligence experts are sounding the alarm. They're noting, quote, "We're short of Patriot missiles. We've been using those things up at a fairly rapid pace during this war." The U.S. defense industrial base is seriously straining under the weight of this conflict, and it desperately requires critical minerals to catch up and rebuild.
Which leads us to this wild concept: vaporized wealth. Modern warfare is incredibly intensive when it comes to silver. I mean, it powers the advanced electronics in everything from hypersonic missiles to drones and satellite guidance systems. And here's the kicker. Once those weapons detonate on the battlefield, Millions of ounces of silver are vaporized. Boom. They are permanently destroyed and completely removed from the global supply forever.
So we're looking at this massive military demand for silver, combined with negligible refining capacity right here in the US, which forces a heavy reliance on overseas infrastructure. Meanwhile, despite all these fundamentals, retail investor interest remains astonishingly low, sitting at less than 2% of financial portfolios. Observers do neutrally note a circulating market theory out there that the military-industrial complex might intentionally suppress silver prices to keep weapon replenishment economically feasible. Now, while that is purely a theory, it perfectly highlights the severe tension between industrial defense needs and global market prices.
Okay, let's shift focus to the geopolitical chessboard. Section 4, China's strategic long game, the real winner of the conflict. Now, what's really interesting here is this. As the US and Iran violently deplete their resources and capital, we have to look at the broader picture and ask, who is quietly sitting back and benefiting? Who really comes out on top? Because the reality is, neither the US nor Iran is the ultimate victor here. The real winner is playing a much, much longer game.
And the data points directly to China. Get this, China receives a massive 90% of Iran's oil exports. On top of that, they control nearly 90% of critical mineral refining globally. That means the US often has to rely on its biggest competitor to process the very metals it needs to build its weapons. Furthermore, military analysts note China is essentially using this conflict to field test its advanced re-entry vehicles against US air defenses in real combat conditions, prepping for potential future conflicts. And while all this is happening, the Chinese central bank and its citizens are rapidly expanding and hoarding their gold reserves.
This brings us to our final act, Section 5, the financial ripple effect, the 1939 moment.
To really understand how this massive military and resource drain impacts the global financial system, we actually have to look back in time. In the 1930s, global forces were manifesting amidst widespread unreadiness for large-scale conflict. Then, by the 1990s, we entered an era of aggressive globalization. The U.S. offshored its supply chains, basically assuming a permanent peaceful status quo. Fast forward to today, and experts like former Defense Secretary Jim Mattis describe our current reality as a 1939 moment. We are far behind the curve, and it's going to require an incredibly rapid, massive capital investment to catch up militarily.
Yet the markets are largely just ignoring this. Veteran market strategists use this brilliant analogy to explain Wall Street's current complacency. They say, quote, "It's like at a crap game where they think there's no longer a 7 on the dice and the game is just going to go on." It hits the nail on the head. Investors are heavily overextended, chasing AI tech stocks and assuming markets will just melt up forever, completely ignoring the global red flags waving right in front of their faces.
But you cannot ignore this number forever. $39 trillion. That is the looming shadow of the U.S. national debt. So the question becomes, how can a nation finance the massive, urgent military buildup required for a 1939 moment while simultaneously running multi-trillion-dollar deficits year after year? The math is just incredibly daunting.
This forces us to look at the financial tools currently being used. The U.S. has weaponized the dollar with incredible economic fury, seizing Russian assets and successfully freezing a $130 million crypto wallet linked to the IRGC. But this is a huge double-edged sword because it inadvertently accelerates de-dollarization. Watching these seizures genuinely scares other nations. It pushes BRICS countries to urgently seek economic alternatives, and it's prompting global central banks to dump U.S. treasuries in favor of hoarding gold as a neutral, unseizable reserve asset.
So I want to leave you with this final provocative thought to chew on. As global powers hoard physical gold, as kinetic conflicts vaporize critical minerals daily, and as the U.S. debt surges past $39 trillion, what is the ultimate fate of the U.S. dollar? Thank you so much for joining me on this explainer today. Keep asking those tough questions and keep learning. See you next time.